This AMT Insight video will review key trends and drivers for the global tin market and offer a few thoughts about the medium-term outlook for prices. So tin hit an all-time high of $51,000 a tonne in early March. That was following Russia's invasion of Ukraine. What we've seen since then is prices have moderated somewhat. Concerns around the impact of Russian sanctions has perhaps eased off a little bit. There's been these growing liquidity pressures for LME metals and nickel and for commodity markets more broadly. And you've also seen some pessimism creeping in about Chinese demand and Chinese growth because of the latest COVID outbreak over there and the lockdown restrictions most recently in Shanghai. Now, over the last couple of years, you have seen two short-lived illiquid price moves that have fallen below the 100-day moving average for tin. But on the whole, I think we can say that this underlying prevailing uptrend we've seen sustained in the market since March 2020 has been largely unbroken and still it has been sustained. So we're still in an uptrend, we're still in an overall kind of bull market situation. Now, in terms of nearby spread backwardations on both the Shanghai Futures Exchange and the LME, we're still seeing fairly significant backwardations beyond what we'd typically see pre-pandemic, for example, but they have eased somewhat from the extremes that we were seeing on the LME beginning of 2021 and in November for Shanghai Futures Exchange. So perhaps less tight than we have seen, but we're still in a tight market. In terms of inventories, that also reflects that. We're still near historically low levels, but we have picked up somewhat from the lows of global exchange inventories that we observed in 2021. Partly we've seen a bit of seasonal restocking in China. Very, very recently we've also seen some deliveries into Belgium and Baltimore LME registered warehouses, which has signalled a bit of improved availability of tin in Western markets, I would say, in recent months. Now, I think a key theme really over the last couple of months for the sustained strength in tin prices overall has really been Chinese import demand. So you can see perhaps a little bit more supply constraint in China versus this improving ex-China supply situation I'll talk about shortly. But really what we saw in March was that real opening and widening of that China import arbitrage with SHFE trading at a fairly substantial premium to the LME. In terms of how that's actually impacted physical trade, we'll see, for now, the first couple of months of the year, China was still a small net exporter of tin. But it's likely that it became a net importer in March, probably to the tune of a few thousand tonnes of tin. And we're likely to see those strong imports maintained for the next couple of months as the impact of that big open arbitrage window we saw in March starts to feed through into actual physical trade. So therefore, we do see some diversion of this recovering ex-China supply from away from Western markets and to China over the next couple of months. Now, in terms of how that ex-China supply is recovering, I think most notably we can see that we had a bit of uncertainty around regulation with Indonesia early part of this year, a real dip-off in shipments in January. But that seems to be behind us now. We've seen relatively healthy levels of exports and shipments from Indonesia in the last couple of months. And they should remain strong, really. There's nothing on the horizon, really. We're past the wet season in terms of potential disruption to shipments in the coming months. I think also as a note, you've got Malaysia Smelting Corporation, heavily disrupted operations last year from furnace outages and then COVID restrictions. But they've got a new smelter up and running. They're doing tolling business through that. They're also boosting output by reprocessing intermediate products at their existing smelter. So I think generally you can building up this picture that we're seeing stronger and more consistent production perhaps in the last month or two than we were seeing in 2021 and maybe in January in terms of Indonesia. Now, I think in terms of Chinese supply, this is another key point. I think you can see the first couple of months this year, we saw very strong rebounds in China ore imports. Dipped off again a bit in February, maybe related a bit more to the shorter month and the Chinese New Year. But overall, what we were seeing was a bit of a backlog of concentrate from COVID-related border restrictions at the end of 2021. They were easing. You've seen that backlog of concentrate really coming through into the China market. And that should really help improve concentrate ability and boost production from some of these concentrate-starved Chinese smelters, particularly over the next couple of months. You've seen some of the big smelters also returning from maintenance, like Guangxi China Tin, for example. That should also help perhaps a rosier picture for China production. I guess the only risk there being really, we are seeing these COVID restrictions re-emerge in China, and there's always the potential that maybe that will cause some fresh border disruption. But at the moment, it seems to be flowing pretty well in terms of the concentrate from Myanmar. Now, if we start to look a little bit at demand, I think this is also key. I think we're starting to see some headwinds on the tin demand side. So if we look at China to begin with, we can see growth rates in China's production of key tin end-use goods. So, kind of household goods, air cons, fridges, refrigerators, computers. They're all showing kind of a flat lining of growth year on year. I think the one bright spot, I think, in China has been solar panel output, particularly for solar demand. And that's sustained some double-digit growth. But, we're seeing a real drop-off from the growth rates of last year. And also, some generally a reluctance amongst industrial consumers to participate fully in the spot market with the spot prices of tin at the moment so elevated. Also, I think it's key, in Europe and the US that consumers generally, they retain quite good savings and spending power, but we've got this developing cost of living crisis that's really starting to come through at the moment in terms of higher energy costs and higher cost of food, just general cost of living pressures that are starting to emerge. This is something that could start to weigh on consumer confidence and consumer spending power in these Western countries. And that shift as well in preference back from services spending to goods spending to services spending, which was the other way around during the pandemic. That's also a bit of a risk as well to kind of tin demand potentially and maybe goods demand more broadly. So I think just talking about long-term demand for tin, I think it's very clear there's some long-term optimism there for consumption. Electronics proliferation. We've got these host of renewable energy applications. So I mentioned solar panels before, doing quite well. And then also future electric vehicle battery technologies as well. That's a potential growth area. But I think in the short term, really, or at least the next year or two, I think that's going to be trumped really by global growth risks and consumer spending preferences. So, we have this tapering of monetary stimulus and this cost of living crisis, as I mentioned, and these broader growth pressures in the global economy. And that's something that perhaps might have a bit more sway in terms of suppressing growth rates, at least in demand in the short to medium term. So how does this all tie together? What's the outlook? What does that mean for prices in the coming months and indeed, going in the years ahead? Well, I'd say tin as a market continues to price scarcity. We still have inventories at relatively low levels. We still have that underlying technical pandemic era bull market uptrend in the tin market, and bull markets don't die particularly easily. You also have, again, this kind of next few months, probably this sustained China imports, physical imports in the next few months that will be diverting that supply from Western markets. So I think for the next couple of months, we're probably still looking okay. Maybe we see a continued drift higher in line with that kind of underlying uptrend. However, as we move into the second half of this year, as we see kind of this improved supply, particularly ex-China, but also in China as well, combined with these rising macroeconomic growth risks, I think that's got the potential to maybe bring an end to that kind of longer held uptrend. So assuming no further supply shocks in the market, which are more than possible, but at the moment they're not a base case, you'll probably see tin prices heading back towards maybe $35,000 a tonne in the second half of this year. I think as these growth pressures globally start to intensify a bit, maybe more into 2023, that's going to perhaps solidify this pullback to more sustainable long-term levels. So, even if we're moving back into the low 30s, that's still more or less way above what we ever were historically for tin. The previous high was in the the low 30,000s in 2011. So we're still high from a long-term perspective, but I think moderating from the extreme highs of prices at the moment is something that I think will ultimately be inevitable. And perhaps in the second half of this year, we'll start to see that. So thank you for listening to that insight. If you are finding these metal-related insights that we're putting out on a periodic basis useful and interesting, I very much encourage you to subscribe to AMT's LinkedIn channel. We also have a YouTube channel that you can subscribe to as well. Make sure you don't miss out on any of the future insights that we're putting out there.